This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Inflation very much in focus. The Fed's Neil Kashkari warning that he's not ready to call an end to rate hikes. Fed minutes from the last meeting drop at 2 p.m. Eastern. How many will be in Kashkari's camp? UK inflation comes in hot again. The pound jumps as holiday prices keep rising. Service sector inflation remains sticky. The news, of course, piling pressure on the Bank of England to keep raising rates. And financial giants face fresh China scrutiny. BlackRock, Allianz, Fidelity, maybe amongst key stakeholders to watch in the country garden debt crisis. This as more local wealth managers miss payments to investors. Keep an eye on that story. Welcome to Bloomberg Surveillance. This is the early edition. I'm Guy Johnson. I'm, of course, in for Danny Berger in London. Kriti Gupta very much in New York. Kriti, there's a lot to think about. This inflation narrative front and center. China not far behind.
Not far behind. I would argue interesting kind of read-through into the market stateside, Guy, because you would think that if those Chinese concerns really did have a read-through, you would see more of a sell-off. And we're seeing the exact opposite this morning. Green on the screen when it comes to the equity market. Futures higher by about 0.2%, 44.63 for our radio audience on those contracts. But, Guy, the market really gets interesting when you look at the bond story simply because of those contradicting inflation metrics. Remember, we had Neil Kashkari, as you just pointed out, saying, well, we might not be done, while all the data kind of points at, well, maybe we might be. So, of course, we're going to everyone's going to play economist for a day, if you will. And I think the bond market is already doing that. The two-year yield coming back down to tune about 5 basis points, 489 on that note. What's interesting is that it is also dragging down the dollar. Now, some of this is coming from the UK, so we're going to talk about the counterweights in just a moment. But take a look at the Bloomberg Dollar Index, weaker at the moment by 0.2%. Again, the China read-through not really there, even though, Guy, I should mention, we did just get Tencent earnings just a few minutes ago. They came in weak, so perhaps yet another warning about the strength of the corporate sector in China as well. And of course, NYMEX crude trading with an 80 handle, about flat at the moment, but you can definitely see the direction of travel is down.
Bit of data out of the Eurozone, Euro area, Q2 GDP 0.3, estimates 0.3. That's pretty much in line with estimates, as I say. What I think is interesting is take a look at the screen right now. Take a look at your Bloomberg. Look at the industrial production number. Comes in way better than anticipated. This is a theme that is developing. The industrial side of the economy seems to be gaining a little bit of traction at the moment. Keep an eye on that. Let's talk about where we are with European stocks. 456. We're basically not too far away. We continue to be not too far away from the 460 level. The markets are getting more exciting as the week progresses, definitely. They started off definitely on holiday, seem to be coming back a little bit in drips and drabs, but we are still in a very tight range. I think I would argue yesterday, negative session, we're a little bit positive this morning. The pound up, unsurprisingly, given that inflation print that we've just had out of the UK. It is coming down slowly. The problem is, though, that core is sticky, services are sticky, holidays are sticky. All of that putting pressure on the Bank of England, plus the wage number yesterday. So the pound is rising on the back of that, 127.59. Kriti was mentioning Tencent. NASPA's the proxy. This is what we've got in terms of the reaction to the numbers. NASPA's is down because Tencent has missed. So that stock down by, let's call it circa 3%, Kriti.
Yeah, a lot to digest in the corporate sector from China as well, but I think the UK perhaps driving the market more in the bond market and the currency market, I would argue this morning. Let's go there. The UK's annual inflation rate fell last month, but by less than expected. This comes as the cost of travel and holidays climbs. The latest figures adding to the case for the BOE to raise interest rates again. Joining us now, Bloomberg's Valerie Teitel. She is all over this data. Valerie, walk us through it.
A lot of the attention this morning was on the core number that came in a tenth stronger at 6.9%, matching the previous month estimate. And if you look at where the trajectory is for core inflation here in the UK, it really has not budged. In the last 3 months, it's only gone from 7.1% down to 6.9%. That is really not a lot to celebrate when it comes to the Bank of England. There was some good news for consumers in this print that headline CPI did fall, driven by a fall in food prices, a fall in consumer goods, which is good for the consumer. But for the Bank of England, it's bad news. We are seeing domestically generated inflation. That is the concerning bit. Very sticky. Services inflation remains sticky and is still on the rise despite the fall in headline. That is the one concerning thing. And Kriti, if you look on a large scale, the thing that tempted the Bank of core CPI print. We got those two today. The fact is, though, we have a long way to go until the Bank of England meets again. It's not until the 21st of September, and we do get another round of data.
The last time I listened to the governor, the last press conference, he was talking about the fact he was nearly done. We're getting ready to pause. That was the message that's been coming from a series of central banks, or at least was. The message seems to be hardening. Kashkari yesterday. It's going to be interesting to see what the minutes tell us today. I suspect the Bank of England's going to have a little bit of a rethink again. Do the markets need to have a little bit of a rethink? How much is being priced right now in terms of the idea that actually rates could be, as they've been telling us, maybe higher for longer?
Well, look, the one big, I guess, vulnerability for central banks that have gotten too dovish too early is just clearly in the bond market, with those real yields staying ever higher for longer. I think the U.S. is a different slight scenario, though, because if we look specifically at what's been supporting U.S. growth, it's been government spending. And what has that caused? A surge of Treasury supply. What has that caused? This surge that we've gotten recently in real yields. And the concerning thing is in the coming months, the trajectory for government spending, we're headed into election year. It's still going to be strong in the U.S. And then if we do get a downturn, we get all these automatic stabilizers of welfare payments. So the trajectory of real yields, to many in the market's minds, is ever higher from here. And that could cause a bit of headwind for equity markets going forward.
Certainly a lot to digest, and of course, we keep coming back to the same theme. Where is the kind of read-through coming from? Is it coming from Europe? Is it coming from China? Of course, something you're going to be monitoring very closely. Valerie Teitel, everyone, for Bloomberg News. We thank you as always. Let's go from Europe over to China. The fate of global investors is in focus as Country Garden sits on the brink of a maiden bond default, with major firms exposed to the property developers' dollar bonds. Joining us now, Bloomberg's Rebecca Chung-Wilkins. Rebecca, walk us through who might be on the hook. Who has the exposure here?
Well, some of the big names that we recognizable to a lot of folks here: BlackRock, Allianz, Fidelity, HSBC, among some of the largest firms with the biggest exposure, at least according to recent filings. Now, worth pulling out a couple of those names. BlackRock up there right at the top, about $350 million US dollars worth of outstanding notes. That filing is just as of a couple of days ago. So most likely seems they probably still have some decent amount of exposure, particularly given the lack of liquidity in this market. Now, just thinking about what that means and the levels of losses that some firms, not necessarily these, but some investors may be seeing on their books. Just a couple of months ago, Country Garden's bonds were trading well above 40 cents. We're now in the sort of 9 cents, 10 cents, 7 cents range. So a significant drop off there. And also worth pointing out at the levels at which these distressed bonds are being priced at. We're not just at a distressed level. Investors are not just pricing for a haircut, but for a really steep haircut. They're not at 20 cents. They're not at 30 cents. This is a very, very low level here.
So what happens next? What's the next step in this process? And what does it mean for local investors as well? I'm seeing more and more trust companies. There's news that they're not making payments. Can I connect the dots? Are these things related?
Yeah, that's a really interesting question, Guy. I mean, on the first point, the next big thing for Country Garden investors will be whether or not they make this coupon payment. So that's going to be about roughly 3 weeks. So look to the sort of first week of September to see whether they make that payment. Onshore, it's been a slightly different situation. Developers have tried to avoid defaulting on onshore, where, of course, the bulk of their business is, instead sort of extending due payments. But as you say, this sign of distress in the shadow banking market is very much connected to the property stress. So trust companies, which have been another form of sort of extending credit to property developers, are now also feeling the pain as more property firms struggle to repay that kind of debt too. Now, shadow banking has been sort of heavily clamped down on by Beijing over the years, but precisely because of these hidden risks. And there are a lot of concerns over sort of transparency once again here. Now, we've seen a giant of China's private wealth management industry, firms affiliated with that, missing payments on trust payments. We had more news of more missed payments as well. We know that regulators have launched a probe looking into the risk of contagion here. But any kinds of stress that spread beyond just this one big giant, and even just seeing it happen at this conglomerate, does suggest we are moving into a different and new, potentially more worrying phase of the distress cycle when it comes to looking at the fallout of this property debt crisis.
The fallout, indeed, that we're going to be monitoring very closely. Rebecca Chung-Wilkins, all over that story. We thank you, as always. And of course, we go from China back to Europe. The world's biggest owner of publicly traded stocks, the Norway Sovereign Wealth Fund, returning 10%, so about $143 billion in the first half of the year. The gains indicate the fund is back on track after one of its worst years. Joining us now to break it all down, Bloomberg's Jan Patrick Barnard. Jan, one of my favorite kind of fun facts about the Norwegian Sovereign Wealth Fund is that back in 2008, when he had that massive tech sell-off, everyone was kind of in the doldrums. This is a fund that really scooped up a lot of tech, a trade that would really prove quite wealthy ultimately for the next 10 years or so. What drove the returns this time around?
Well, it was no surprise here, tech again, as the fund, of course, it's so large. So there are two things that they need to do. First of all, I mean, they want to be in the part of the equity market where there's the most juice, and that is still undoubtedly U.S. tech, even with the wobbles that we saw last year. So that is still a big weight for the fund. And on the other hand, given it's so big, it also needs to pick those stocks that are big in market cap, because it makes easier for the fund to handle it going in and out in those stocks, because they just simply provide more liquidity. So no surprise here that the fund is like big in U.S. tech, and that drove a major part of the performance, as we saw like the Nasdaq being up almost like 40% this year.
JP, that worked. What didn't?
Well, there are a few other things. Again, the fund is so large that you have to spread your assets all over the place to make sure you're well diversified. But that also means like it has a lot of benefits, but it also means like that the chances are high that you are almost always part of something that doesn't work. And that in this case was some losses here from Silicon Valley Bank. So the fund was also involved in that one. We also saw that commercial real estate, non-listed commercial real estate is an issue for the fund. I mean, we just heard from what's going on in China. So that's probably an issue to stay. And then renewables is also something that didn't work very, very well for the performance. Again, something that we have seen in Europe as well. If you look at the results of Siemens Energy or of Vestas, then you know what's going on there. And that's not an asset that is performing particularly well in these last couple of months.
JP, thanks very much indeed. JP Barnett joining us on what is happening with the Norwegian Wealth Fund. We're going to hear from Nicolai Tangen, the CEO of that fund. That interview is going to be on Bloomberg Surveillance. It's going to take place at 8:15 a.m. Eastern Time. Looking forward to what he has to say. A little bit more detail coming, I suspect. Coming up in this hour, though, today's UK CPI definitely fueling BOE rates hike bets. What happens next? We're going to find out. We're going to get a guide to what could be coming from the bank. Senior economist Kallum Pickering joining us from Berenberg. Plus, US retail earnings in full swing. Target reporting its results in just over an hour. More ahead of that. This is Bloomberg.
Well, the story is all about the bond market. Even though we are smack in the middle of the summer, you are seeing some sleepy trading, yet plenty of action. I think Guy Johnson will agree with me on this, which brings me to a chart I want to show you. For our radio audience, stick with me. It's a pretty simple one. We're looking at the 2-year yield, nothing too fancy, but it's a chart that goes all the way back to, let's call it the spring of 2022. And basically what you see is this acceleration in the yield story. We knew that, inflation ramping up. And then it kind of stayed a little bit range bound for, I want to say, the next, 18 months? Or so, but it is continually testing that 5% level. I think this is interesting as we talk about what the terminal rate might be, guys. Simply this idea that you continue to see this yield story moving higher and lower, not necessarily on a change from Federal Reserve policy, but I think more from the cut story that's priced into the market. And yet here we are again this morning retreating from the 5% level.
Yeah, it's a key line in the sand, isn't it? And it's a massive moment for the market once again. The narrative seems to be quite clearly, though, that the Fed is going to push back on the idea that we're going to see cuts. The market up until now has not believed the Fed when it says it's not going to deliver cuts. But the market keeps being confounded by the Fed. It actually continues to be confounded by the data as well, which keeps coming through stronger. You look at the nowcast data at the moment, it is pointing to a US economy that is miles away from a recession. Why would the Fed be cutting if we are miles away from recession? Why would the Fed be cutting if we're still in an environment where it doesn't know whether it's beaten inflation? So the market keeps projecting and thinking, yeah, you know what, normal cycle, we're going to be seeing the Fed cutting.
Yeah, and I think
the Fed just keeps pushing it back.
I think to your point, it comes back to the same question that we've been asking our guests all week. Resiliency or recovery? What does this actually look like? Because if you are looking at resiliency, if you are looking at that confidence in the market, does that just mean yields go higher and higher? And at the end of the day, when does market plumbing and the bond market specifically become an issue for the Federal Reserve? Essentially, at the 2-year yield, it is at the tied to that Fed policy. So if the Fed is saying, look, we're not going to cut, but the economy is doing fairly well, that's not great for people who are betting on or who are bullish on bonds moving lower.
Absolutely not. And you've got two different arguments as well. You've got the front end story about Fed cuts, plus you've got the long end kind of deficit story, this bear steepening that we've seen, which could keep rates over the longer term higher, which is something else that the market's had to deal with. So that kind of move up in the middle, in the belly, has been really significant as well. That's been certainly something to watch out for. The idea of cuts just continues to really. The market's really struggling with figuring out what it's going to look like. What kind of a curve are we going to be getting? And there's all kinds of things at the moment pointing to higher rates. And then you extrapolate that and you take that into the equity market. The equity market is not positioned for these kind of high real rates as well. That is another factor that we've got to bear in mind here. You then fold in liquidity. As that starts to ebb away, is that going to be another problem, another headwind for the equity market?
Yeah, and a lot of that has to do with simply those longer term kind of stories when you talk about those inflation expectations that you just brought up. But then you have to talk about the consumer inflation expectations as well. Ask your man on the street. They'll say, well, actually, I think inflation is going to be there for longer. Guy, we're going to digest all of this coming up shortly. We've got Kallum Pickering from Berenberg Economics. We also have FOMC minutes coming up later. We're going to digest all of it. But for now, stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Let's get some key news developments we're following this hour. President Biden says he plans to travel to Hawaii to see firsthand the devastation from the Maui wildfires. Biden says he's spoken to Governor Josh Green, so the trip does not interfere with the rescue work. The wildfires have killed almost 100 people, making them the deadliest in the United States in over a century. One risk modeling firm says the disaster will cost insurers more than $3 billion. Guy, this is an evolving situation. We know the death toll keeps climbing. All eyes on Washington about how they're going to handle it.
Yeah, there's been a lot of criticism as to why the president hasn't engaged with this story a little bit earlier, why he hasn't gone. You've seen this time and time again during this administration, that maybe the administration has been slow to respond to crises. You saw that with the derailment. Maybe we're now seeing that with Hawaii. I want to talk about what's happening with the union story, because this labour market narrative, I think, is so fascinating at the moment, Kriti. The leader of the United Auto Workers Union is asking members to grant him the ability to call a strike. Now, this is interesting because he's arguing that the contract talks with the big three in Detroit, the big three car makers, basically are moving too slowly. The group has been negotiating with GM, it's been negotiating with Ford and Stellantis for 30 days. The parties have yet to discuss economic terms. He wants to get on with it. He wants to accelerate the process. Now, obviously, there's a kind of mechanical process that he normally has to go through. And he's saying, you know what, we need to speed it up. We need to basically get the rubber to meet the road, and we need to get on with this.
What's interesting is he's essentially taking a page out of the Teamsters Union playbook. This idea here that you should actually be more aggressive towards these companies rather than kind of engaging in these diplomatic channels. It's something, by the way, that you're seeing even the Hollywood strikes kind of use as a way to deal with the studios as well in California and around the world. So certainly something you want to keep an eye on. We should mention, by the way, we have an open invitation to the United Auto Workers president in right now. So hopefully he will join the network soon. But Guy, in that same vein, let's talk about an industry that's actually been affected a lot by the unions. That, of course, is going to be the logistics story. An affiliate of Ken Griffin's Citadel is said to have acquired roughly $485 million in yellow debt, previously owned by Apollo and other senior lenders, to the bankrupt trucking firm. The deal comes as Yellow seeks to secure a bankruptcy loan to fund its liquidation. Now, of course, remember, for the folks who aren't actually following this, the Yellow Trucking Company goes back almost a century in terms terms of kind of really building, I think, the infrastructure of the United States. But in the last 10 years or so, it really hasn't been able to recover from the global financial crisis. And that is an important part of their bankruptcy story. Now, in recent weeks, they've actually come out and said, well, that Teamster union, which represents, I think, a good chunk of their workers, not the majority as it does with some of the other logistics firms, but a good chunk, they are actually saying, well, it's because of those union negotiations that we went bankrupt, even though we do know there is that a loan that they still have from Congress issued to them during the Trump administration. A lot of cross currents here, but Wall Street already acting on what they're seeing.
Absolutely. A lot of people I've been speaking to, this is not my opinion, this is the people I've been speaking to, believe that this company was already on the brink, that it's been teetering on the brink for a very, very long time. I think pointing fingers maybe is a little unfair at this point. But I think the bigger picture that you raise about what's happening with unions, I think is really important. There is a clear demographic shift which we are beginning to enter. You've seen labour shortages from the pandemic. That story feels to be over. We're now entering a kind of new phase. And we were talking yesterday with Jean Boivin about this, a new phase in which the demographic story is going to mean that there isn't going to be this large labour force. And in that environment, you would have thought that Labour, you would have thought the unions would have significantly more power. And that, in theory, could drive higher wages.
Well, it already kind of is, and you can see that in some of the bottom lines. I mean, UPS, for example, a couple weeks ago, their stock tanked simply because of the margin pressures coming from these wage negotiations. Disney, Netflix, they are dealing with the same issue, Guy. This is something we're definitely going to be talking to our next eco guest about, no doubt.
Absolutely. I do wonder whether what the kind of the cases you raise, whether that's related more to what is happening with the pandemic rather than the kind of the demographic shift. Anyway, as you say, we'll talk about it. Kallum Pickering, senior economist at Berenberg, is going to join us next. UK CPI, hot, hot, hot. We'll talk about it next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation in focus. The Fed's Neil Kashkari warning he's not ready to call an end to the rate hikes. Fed minutes from the last meeting drop at 2 p.m. Eastern today. How many will be in Kashkari's camp? And UK inflation comes in hot yet again. The pound jumping as holiday prices keep rising and service sector inflation remains fairly sticky. The news piling pressure on the Bank of England to keep raising rates. And financial giants face fresh China scrutiny. BlackRock, Allianz, and Fidelity may be among the key stakeholders to watch in Country Garden's debt crisis. This is more local wealth managers miss payments to investors. I'm Kriti Gupta in New York with Guy Johnson in London. Guy, we talk a lot about the China story, the inflationary story there, and whether or not they're actually exporting deflation. You're already seeing a pullback in their property sector, even their tech sector.
Yep.
I'm not sure that's having a read through into the rest of the world, though.
It may not. This may be one of those stories that takes a while to come through. But in the past, for those of us that lived through and I know you read about it, those of us that lived through the devaluation, we have seen the impact that China can have on the economy. You came out of the last crisis, 2008, 2009, China powered the global recovery. It's not going to be there this time, potentially. Stock 600. I'm being told watch 453. There's a key line in the sand there on the moving averages. We're basically flat. Again, quite range bound. Within there's some individual stock stories that are worth focusing on. Pound's up quite strongly, up by 0.4%. The market seems to believe that yesterday's data and today's data, the CPI number, will encourage the Bank of England to go further. The market is now pricing 6% as the terminal rate. Tencent has missed the proxy in Europe. Naspers, big stakeholder. That's stock Kriti, down by 2.88%.
Yeah, I mean, you bring up a good point about the devaluation. And Guy, I will say I'm both older and younger than I look. We'll leave it at that here. When we look at the futures trade, though, it gets really interesting. Green on the screen at the moment, but paring back a lot of the gains we saw just 30 minutes ago in New York. 44.59 on the S&P futures, higher by 0.1%. Again, not any major conviction in either direction, but enough to say, look, maybe there is a little bit of positivity. Remember, yesterday we sold off, though, so it might just be a simple reversal of that on this light summer day. The two-year yield gets interesting as well because really it feels like the repricing is mostly coming from the bond market, not necessarily the equity market. Those real yields are going to be playing a role, especially as we talk about the read-through, not from China, but from perhaps the UK and Europe, where you are getting extremely hot inflation data. Two-year yield, 490 is where we'll call it. The yield story bringing down the dollar as well. And again, that's also going to be a function of the UK story. So that's going to be something we want to watch as well. Bloomberg dollar index down about 0.2%. But Guy, if we're talking talking about a pullback at some point or even resilience in the economy, you would think there would be more volatility in the crude market, and we're not really seeing that. NYMEX crude really testing the 80 level here, now 81, really unchanged on the day, but perhaps that's where the volatility is due to pick up.
Crude came up pretty rapidly. It now seems to be consolidating a bit. But yeah, it's a good point, and it's well made. Let's talk more about that inflation story, Kriti, and how the Fed is reading the narrative that it sees in front of it. Investors are now waiting for the Fed's latest minutes. I think they drop at 2 p.m. Eastern. What we're going to get there is a glimpse of the official thoughts on the bank policy path from the last meeting. Neil Kashkari, though, has gone from being dove to being a firm hawk. And it was interesting listening to him yesterday, very much making the case that he feels that the Fed should not be done yet.
Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
So how many will be in Kashkari's camp? It's going to be interesting to see whether it's just a minority that believe that the Fed could hold at these current levels. And what is the read across into other central banks? You look at the wage data out of the UK yesterday. You look at the CPI number out of the UK today. Kallum Pickering, senior economist at Berenberg, joins us now. Do you think Kashkari's right? Do you think the Fed might have more to do? The market's anticipating that we're going to be seeing cuts soon. He's pouring cold water on that.
I wouldn't eagerly anticipate cuts because all of the latest data from the US is consistently better than expected. There's a lot of resilience in the economy, but monetary policy is now tight in the US. By definition, that will disinflate prices over time. It's just a question of how long it takes. If you're willing to tolerate an 18-month horizon and just accept actually we'll benefit from this stronger than expected economic data, great. If you're desperate to get inflation down quickly, you run a recession risk. I think the Fed does not want to run a recession risk, and I don't think the administration wants a recession.
So it's done enough. It can sit tight. It can wait for the real rates to work their magic, and the economy will glide to a soft landing. Can you say the same thing about the UK?
The Bank of England is still on course for a soft landing. We didn't get the recession over winter that was widely anticipated. The outlook is for an improving economy over the next 2 years, but it won't happen immediately. The Bank of England should be thinking probably one more hike and then done. Slight risk.
Market's pricing 6% terminal.
Yeah, my view is that's too high. We need to just keep in mind central banks often make policy mistakes. They tighten too much and they ease too much. The reason why is because once the balance of evidence has shifted in favor of stopping or indeed hiking, depending on which way you want to go, they just go further. This is human nature. We have a bias problem. We know this. And so sensible policy accounts for this. It accounts for the fact that monetary policy works with a lag, which means you stop hiking well before inflation is back on target. If we hike until inflation is on target, you've gone too far by definition, you get your recession, which is the thing we need to avoid.
Kallum, when we talk about the UK in international context, it feels like the narrative continues to be that inflation is stickier in the UK simply because of kind of the structural hindrances that the economy has there. Talk to us about how the wage picture plays a part.
So wages in the UK at the moment are much too high, running at the 7 to 8% range year over year. However, the setup in which wages are being bargained up does not suggest that the UK is suffering from this so-called wage price spiral. Why do I say that? Inflation expectations on consumer surveys and the Bank of England's own survey are coming down fast and are now actually slightly below the Bank of England's target on a 2 to 5 year view. If wages are high in that context, we can't conclude that wages are being bid up in anticipation of high prices in the future. That's the conditionality for a wage price spiral, because those prices then become self-fulfilling once you spend those wages. What we actually see is tight labour markets providing workers with the ability to actually fight back against these cost pressures and defend their real incomes against the losses of last year. My bet would be, with a dramatic easing of labour market tightness, and there really is a dramatic easing now in the UK. You look at the single month estimates, employment is plunging, the unemployment rate is rising fast, vacancies are coming down. I don't think there's any basis to think that these wage growth numbers will remain elevated into the next few months. And in fact, actually, I think we're going to be surprised to the downside, that wages lag inflation.
If wages do actually lag inflation, though, and you are still seeing this upward trend in even just nominal inflation in the UK, is that divergence concerning to you? And to me, that feels like there's going to be a massive dislocation then in the economy.
Yeah, I mean, we have to think about base effects, actually, when it comes to inflation. So headline inflation on the month of June declined by about 0.5 percentage point. That was due to the fall in energy prices, the prices that consumers paid due to a policy effect. The market has focused a lot on the core rate, which moved sideways at 6.9%. But if you abstract from the base effects, if you look at the last 2 monthly numbers for core and you think about those in annual terms, actually core inflation is running at 2% for the last 2 months in the UK. That's down from north of 15% in spring. So there's been a huge drop-off in core inflation. The only thing that remains a bit of an inflationary echo is services, but that should turn down in line with wages because services have a huge wage component.
Governments are driving spending, deficits are going to be big, rates are going to stay high. We're shifting into a demographic deficit where we're going to be seeing fewer workers come in. That's going to give workers more power. All of that sounds inflationary to me. All of that sounds like we are going into a period where rates are going to stay significantly higher than they were pre-pandemic. What's wrong with that argument?
There's nothing wrong with that argument. The point that rates will stay higher is sufficient as a base case, but then the question is, what does the volatility around that look like? So I wouldn't say that inflation will be structurally higher, it just will be more prone to bouts of inflation because of this tighter balance between demand and supply. The other thing to say is that if monetary policy is set appropriately, there's no reason to have structurally high inflation. Central banks can pick their inflation rate. The big question here, the big uncertainty is...
Do you think that should change?
Say that again.
You think that sorry, just to be clear, you're saying that we shouldn't have the 2% target, we should have a different target?
No, we can get to the 2% target. Central banks can set that. It's just, it might need a 4% base rate into the future instead of a 0% base rate. Once you set monetary policy right, you can keep inflation where you like it. But in response to these price signals, do we get more investment? And that's where I think there's a potential upside risk here, because we can see the potential technologies that can be integrated into supply chains and into businesses that help reduce unit labor costs, they help displace labor, and yet we haven't seen that dispersion over the last 10 or 15 years. The price signal now is telling us to invest. If we tighten too much and cause recessions, you don't get the investment. And so this is a finely balanced policy dilemma.
Kallum, a final question to you on the U.S. here stateside. We get FOMC minutes this afternoon, 2 p.m. New York time. What are you watching for?
Neutral from the Fed. They'll stay data dependent. I'm almost desperate now for all central banks just to stop hiking rates as soon as possible and just let the past hikes over the next 12 months work their magic. And if we avoid recession but land at 3% on core inflation, that's absolutely fine. It's much better than a recession that puts the economy back to sleep, and in 3 years from now, we're stuck where we were in 2013 to 15 with no inflation, low interest rates, and this incredibly sluggish economy. The great thing at the moment is economies are awake. They're moving. We have price signals. Employment is strong. It's very, very risky to end this process.
A believer in the monetary policy lag. Berenberg's Kallum Pickering, we thank you as always for joining the program. Coming up, we go from the macro to the micro. Intel terminating its agreement to acquire Tower Semiconductor. More on that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Wally Adeyemo, Deputy Secretary of the U.S. Treasury Department. That coming up at 5 p.m. New York, 10 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Intel walking away from its $5.4 billion deal to acquire Tower Semiconductor for no other reason than regulatory issues. Surprise, surprise. We're joined now by Bloomberg's April Roach, joining us all over this deal. April, this was a pretty heavily kind of marketed deal, it felt like. Why is Intel terminating it now?
Yes, so Intel announced this morning that it is terminating its plans to buy Tower Semiconductor due to difficulties with getting regulatory approval on time. And Bloomberg had already reported that Intel was expected to have to call off this acquisition. The deadline for the deal was midnight, California time, on August 15th. And by that time, both companies still hadn't received regulatory approval from China. So under the terms of the agreement, Intel said it would pay a termination fee of $353 million to Tower Semiconductor for this.
Just talk me through why they wanted this in the first place. What was the industrial logic to do this deal?
Yeah, so the deal was part of Intel's plans to get into a faster growing part of the semiconductor industry. And that specifically is the foundry market, where companies make chips for companies on a contract basis. And while Tower Semiconductor had a relatively small presence in that area, it did have the expertise and customer list that Intel was lacking. So Intel was hoping to combine its plants with Tower Semiconductor and really tap in to that client list. But what we've been seeing is that due to growing tension between the US and China, it's becoming increasingly difficult for companies to secure deals that require sign-offs from regulators in Washington and Beijing, particularly when those deals involve semiconductors.
Bloomberg's April Roach all over that story, and we should very quickly point out that the regulatory approvals really did come from all around the world, China as well as the EU, of course. April Roach again all over that story. We continue with the corporate story and a look at retail earnings, continuing with Target on deck today. We're going to discuss what to expect from their results. Already seeing a pop in the stock. That coming up next. This is Bloomberg.
This is Bloomberg Surveillance. This is the early edition. I'm Guy Johnson. I'm in London. Kriti Gupta's over in New York. Kriti, it is 5:49 a.m. in New York City. Let's talk about the day ahead if you're just waking up. U.S. housing starts, the data there drops at 8:30 a.m. Eastern. Get the Fed minutes. They come out at 2 p.m. We're going to get remarks a little later from Chicago Fed President Austin Goolsbee. That happens at 2:30 p.m. Finally, of course, we get Target. We get TGX reporting earnings before the U.S. market opens.
Well, let's dive into that story a little bit. Target expecting to report its first sales decline in 4 years. Joining us now, Simone Foxman, all over that story. Simone, when I think Target, now I'm kind of traumatized a little bit by that one sell-off that we had that one quarter from Target, where it was really all about inventory, and then it kind of took the entire market with it. This time around, are we going to see that same kind of pullback, perhaps, in the retail sector?
Well, on the inventory side, I mean, most analysts are pretty optimistic that the biggest issues are behind us. We did see the company pull down its inventory dramatically in the last 2 quarters, first slowly and then by a bit more last quarter, and we expect to see that continue. This is just moving past those pandemic-era supply chain issues where all of a sudden these retailers had all this stuff. They've been able to use discounts, sell it off, and that will hopefully improve margins. The concern on Target's side is, however, that we could see sales that are even worse than anticipated. What analysts are looking for is negative 3.75% comp sales estimate for 2Q over a year-on-year basis. But some of the alternative data sets, like Bloomberg Second Measure, have come in a bit worse. And I think if we were to see something like that, we could see a real negative move on the shares and maybe some impact on other retailers as well.
Okay, so we're going to look at Target. We're going to see what happens there. And then the next thing we're going to do is try and figure out what that means for the rest of the retail sector. Specifically, what does it mean for Walmart et al.? What kind of a read across am I going to get here?
I mean, Target lives in this world, sort of consumer discretionary, but sort of consumer staples, right? And it's really been pushing into the consumer staples side of its business. Food accounts for about a fifth of its overall revenue, and it's been trying to make that even more so. That's an important one for Walmart. That's somewhere that Walmart's really seen some strength over the last couple of quarters. Similar, you can draw this through to Costco, draw this through to some of the other retailers we'll see over the next 10 days plus. And if it can make money on that side, that's a good thing because that shows some resilience, even if the consumer's pocketbook is a little bit stretched. But I mean, think about what we heard from Home Depot yesterday, which was they saw a pullback in some of those higher end $1,000 plus purchases, things like patio furniture and appliances. That's something that could also hit Target as well in its sales of electronics. And of course, that feeds through into Walmart, into Lowe's, other retailers. And so that's something that we're really going to be paying attention to. Exactly what are people spending their money on, and have we seen that weakness on the top end?
Guy, I've got to ask you, have you ever shopped at a Walmart? Just out of curiosity.
I've been to a Target. I've been past a Walmart. I've never actually been into one. But after getting so much grief from Alex Steele a while ago, when I was in Seattle last, I made it a mission to go to a Target.
The Target
my
dollar
producer
section.
at the time forced me to do so as well.
Well,
I spent a good half hour in there. It was very exciting. Slightly confusing, but very exciting.
Well, I think what's interesting for Target is that they do a little bit of everything, and that's really, Simone, the business model that I think Walmart has tried to adopt as well. Because Target has groceries, they have furniture, as you just pointed out, they have that dollar section that everyone loves to go to. But then Walmart is really just kind of thought of as where you get your really cheap groceries and then your fuel, and that's it. Right?
I mean, you know, Walmart does more than that. And I think that they've especially tried to invest in their food business. They've done a big push in that. They've tried to invest in some of their online businesses, bringing third-party retailers in to try and compete with the likes of Amazon. They've taken, I think, a bigger bite out of the retail apple than Target has. Is that a good thing? Is that a bad thing, especially when the consumer is a little bit more strapped for cash? I think we'll see.
I've been to a Trader Joe's. That was definitely an experience.
Trader Joe's is an experience. The lines, every time.
Yeah. Everybody felt like everybody it was almost a religious experience going to a Trader Joe's. Is Walmart going to be able to keep the people that have traded down? That's my question for this week.
Well, I mean, Walmart, I think, has this beauty and this curse, right? And that a lot of locations, it is the major, enormous retailer there. And so it draws such an enormous share of business, especially across, you know, places in this country that don't have anything else. The challenge, I think, is the competition. Well, on Walmart's basis, is the challenge is the competition with Amazon, which is increasingly trying to serve those very same customers. Really struggled with things like food, but pushing $1 billion into investing in that space. That said, you know, I think if the trade down is only intensifying, then we could see even more people potentially going to Walmart. You look at McDonald's, for example, maybe a decent proxy. They've seen, you know, I think they were looking at comp sales of 12%. That was a very strong among broader consumers for food. So we'll see if Walmart can capture that on the broader retail side.
Bloomberg, Simone Foxman, all over that story. I got to admit, one of the things I missed about New York is I don't really have access to a Walmart superstore, which makes things a little challenging from this Dallas girl. But let's take a look at some of the stocks we're watching in pre-market trading and a quick check on those retailers here, because, of course, Target and TJ Maxx, like as we were just talking about, report before the bell, both higher in pre-market trading. TGT is your ticker there, higher by about 0.5%. TJ Maxx not far behind, again, higher by 0.9%. The theme there, resiliency, and that's of course going to have some sort of macro read through as well. Let's get to Hawaiian Electric shares, actually up this morning, and of course we know, just given the devastation that we have seen in Hawaii and of course the carnage in the utilities front as well, you are seeing a pullback in those shares. Is that a fundamental narrative? Not necessarily. That might simply just be a function of buying the dip guy, but you are seeing those shares higher by 4.1%. And lastly, another interesting move this morning, Kava, the recently IPO'd kind of fast food company, higher by about 12%, better profitability in their first update since their IPO. Our markets producer Dan Curtis pointing out that their projected profit margin, guy, is of at least 23%. The only company in the index higher is McDonald's. So real growth prospects for Kava.
Sparkling performance. Bad joke. Big day coming up, I think. Target's going to be fascinating. I'm looking forward to the minutes. We've already got to digest the data out of the UK. Kriti, good setup.
A lot for surveillance ahead to digest. That, of course, does it for the early edition. Stick with us. Nikolai Tangin, the Norges Bank Investment Management CEO, joins the program. This is Bloomberg.